When markets tremble at the mention of tariffs, even tech giants aren't immune. Supermicrocomputer SMCI saw its stock nosedive 18% on Wednesday, after a fiscal fourth quarter report that left investors reeling. The company's earnings and revenue figures missed expectations, with the shadow of President Donald Trump's proposed tariffs casting a long, unwelcome pall over its outlook. But here's where it gets controversial. How much control can a company truly have when geopolitical forces dictate the terms of trade? Let's unpack the numbers and the narrative. CEO Charles Liang addressed investors on a conference call, stating the company has taken proactive steps to mitigate the impact of the tariffs. CFO David Weigand, however, painted a more uncertain picture. The tariff landscape is fluid, he admitted, adding that the company is closely tracking developments ahead of potential announcements next week. We're in the same boat as every other business, watching, waiting, and adapting as needed. This admission raises a critical question. Should investors trust a company's ability to navigate such unpredictable terrain? Or is the blame game already starting? The financial details tell a story of mixed signals. Supermicro reported adjusted earnings of 41 cents per share, falling short of the 44 cents analysts had predicted. Revenue of $5.76 billion also lagged behind the $5.89 billion forecast. Liang attributed part of the shortfall to a June revenue dip caused by working capital constraints and unexpected specification changes from a major new customer. Imagine building a custom car for a client, only to have them demand a last-minute engine swap. Costly, disruptive, and hard to plan for. The company's recent success in AI servers powered by NVIDIA chips had been a growth engine, but that momentum is now stalling. Supermicro's guidance for the fiscal first quarter, 40 to 52 cents per share on $6 billion to $7 billion in revenue, fell below Wall Street's 59-cent and $6.6 billion expectations. For the full year, the company now forecasts at least $33 billion in revenue, a significant retreat from its February projection of up to $40 billion. While this still outpaces the LSEG consensus of $29.94 billion. The revised numbers hint at a more cautious strategy. And this is the part most people miss. The stock's year-to-date performance reflects not just financial metrics, but investor sentiment. Tariffs, supply chain hiccups, and shifting client demands are all playing a role. But is the market overreacting? Or is this a wake-up call for a company that once rode the AI wave? So, what's next? Supermicro's ability to pivot in a high-stakes trade environment and its capacity to retain AI-driven growth will be under intense scrutiny. Do you think the company can weather these challenges? Or is the writing on the wall for its current trajectory? Share your thoughts in the comments below. After all, in a world where tariffs and tech collide, every investor's opinion matters.